Please hand your quizzes in towards the end of each row. No, either end, it's okay. I'll collect them from either end. Time is up. Please stop writing. Thank you. Time is up. Any more quizzes down here? Thank you. Time is up, time is up. Time is up. You felt much better about this one?
Yeah, I do. Thank you so much. This is an extra.
You can throw it away. Just leave it.
We'll see soon enough if
Yeah.
I'm right or wrong.
Yeah. Any more quizzes out there? Time is up. Sorry. Time is up, definitely. Thank you. No. Come on in, get settled, please. Okay. Same rules as last time, so when the quizzes are done, I will let you know. You can come pick them up. It'll be sooner than you think. Yeah. Probably not today, but sometime early tomorrow. And I'll send the solution sheet with the grading template so you can check to see where you lost the points. If you have issues, bring it in. So you know the drill by now, right? So it's the same drill. Okay? So if you looked at that quiz, it was basically I chopped down a capital budgeting project into 4 pieces and gave you 4 pieces, right? Rather than have you do one big project. Okay? The first problem, there were 3 issues you had to deal with. The first was I was asking you to compute a cost of capital in a different currency, right? That was one issue. The second was that, actually 4 issues. So the second was that the project was actually not for the whole company, but for a subset of the company. Hotels for one half, restaurants for the other, depending on which version of the quiz you got. The third was that the mix of revenues for that project were 80-20, nothing to do with the rest of the company. And the final was, I thought I was making your life simple by saying, this is going to be an all-equity funded company. And then I asked you for a cost of capital. You're saying, it's all equity funded. Why is it? Because if you're all equity funded, your cost of equity is your cost of capital. So the first problem is really about breaking it down to pieces. Are you working in the right currency? Are you using the right beta? Are you using an equity risk premium that reflects the project? Are you correcting with the fact that this has no debt? The second problem was actually a very small subset of a cash flow problem. Why was it a subset? Because there are only two items. I gave you the incremental EBITDA, right? I told you how much the EBITDA would jump. And you had one more item to deal with, which is depreciation. After that was just, can you compute cash flow based on... So all you have to do is remember to add back depreciation. And then my guess is about 20% of you got so excited about getting the after-tax operating income right that you forgot to add back depreciation. Happens all the time. Just don't let it happen in the real world, because that'll leave a lot of money on the table. The third problem, I asked you to compare two projects. They were mutually exclusive. They were both cost projects. Right? There was no revenue in either project. It was basically an upfront cost versus an annual cost. So one had higher upfront cost, the other had lower upfront costs, and they had different lives. So really, as the theater owner, you had to decide which was the less expensive option, which meant that first you had to compute the net present value of the two options. Okay? And the second is, because they had different lives, you can't compare net present values, because after 4 years, then what are people in your theater going to sit on if you have no seats, right? So you're going to have to adjust for the fact they have different lives. So converting the net present value into... I was a little surprised, because I was checking the solutions in the last problem that people didn't find it to be a slam dunk. What was the last problem about? I basically had an expenditure, an investment, and I gave you two choices, right? You could either depreciate it or you could expense it. And the question said, what is the effect on your net present value of expensing something rather than depreciating it? I know this is going to pull a scab off a wound, but the scab might not even have formed yet, so it's pretty raw right now. So let's deal with it while it is there. What is the cash flow effect of depreciation? Somebody remind me again, what is it? It's a tax rate times the depreciation. It's not the depreciation itself, because the depreciation itself does nothing for me. I subtract it, I add it back on. It's a tax rate times the depreciation. So when I depreciate something, I get an annual tax savings every year for the next 4, depending on your 4 years, 5 years. If I expense something, what's the cash flow effect? I get the tax savings right away. So all it is basically the tax rate times your expenditure today versus the tax benefits of depreciation. I swear, the first 15 quizzes I saw basically present value of depreciation versus present value of the total expense. That's not a cash flow effect. Depreciation is not the cash flow effect. It's a tax rate times the depreciation. Okay? So I should have really made the question a tricky question by saying the tax rate is 0. In which case, what's your answer to the question? There's no effect. I can do all the dances I want about depreciating and amortizing. If there is no tax benefit, who cares? So it's really all about the tax rate. So you'll get the quizzes back tomorrow. You will be able to see the kind of, you say, I can't believe I did that. Because let's face it, you know that you should multiply the tax rate by the depreciation. You just got to the fourth question and you were tired. You just say, okay, I'm done. This looks easy. I'll slam dunk it and move on. Just go back and look at that tax rate, because that, I think, is the most critical part of understanding depreciation. So let's go back to where we were on Monday. We were talking about the trade-off between debt and equity, right? On the one side, you have tax benefits and added discipline. The tax benefits come from the fact that interest is tax deductible, cash flows to equity are not. The second added discipline comes from the fact that you think that managers in some companies will be a little more careful about the way they pick projects if you force them to borrow money. And on the other side of the equation, you have expected bankruptcy costs, which is a function both of the probability that you go bankrupt, which measures how much your earnings vary over time, and the cost of bankruptcy. Two components of the cost. There's the direct cost, which is what happens once you go bankrupt and end up in the legal system. The second is the indirect cost, which comes from the fact that if people think you're in trouble, it starts affecting your operations. The agency cost reflects the fact that when equity investors go borrow money from a bank, or from bondholders, the bank or bondholders will start putting constraints on the company, not because they're control freaks, but if they don't, they know they're going to be taken advantage of. Those constraints either take the form of higher interest rates on your debt or will take the form of restrictions on what you can do as a company. That's the agency cost. And the third cost is every time you borrow money, you give up some future flexibility. It's very qualitative, but it's actually a very powerful way to start thinking about debt. And I'm going to use my companies to think about how these trade-offs will play off. So let's start with tax benefits. Across my 5 companies, the highest tax rate companies are Disney and Bookscape because they happen to be US companies. Holding all else constant then, I would expect Disney and Bookscape to borrow a lot more money than the other companies. One thing to note about Vale, it's a Brazilian company which has a 34% tax rate. But Brazil also has this quirk in the tax code where if you have equity, you're actually allowed a tax deduction for equity. It's called interest on capital. You're actually allowed to take your book equity, multiply by rate the government sets. What it effectively does, it reduces the tax benefit of debt. So holding all else constant, I would expect Brazilian companies to borrow less than another company in another country with a 34% tax rate. So from a tax benefit perspective, Disney and Bookscape should borrow the most. From the perspective of added discipline, remember this is when you're borrowing money to make yourself more careful about the way you pick projects. I would not expect Bookscape to need any because it's a privately owned bookstore. You shouldn't need debt to make you more disciplined. Baidu is insider control. The owner actually is the founder is the CEO, owns a big chunk of the company. He shouldn't need the discipline of debt to go out and borrow money. The company that I think would benefit the most is the company with the biggest separation between managers and stockholders happens to be Disney. So in both the tax benefit and added discipline, it looks to me like Disney has the biggest advantage from borrowing. Let's think about the costs. Expected bankruptcy costs I'm going to divide into 2 halves. First is I'm going to look at your earnings and cash flows and look at how volatile they are. Why? Because if you have stable earnings and cash flows, you're less likely to run into trouble than if you have unstable earnings and cash flows. And from that perspective, almost every one of my companies has an issue. If you take Vale, it's a mature company, but it's a commodity company. You're saying, so what? Even a mature commodity company like ExxonMobil is going to see its earnings go up and down because you're very much a function of what commodity prices are. So with Vale, that's what I worry about, is earnings and cash flows could go up and down. If I borrow too much money, I'm going to be in trouble. With Baidu, I have a technology company. I'm concerned about the underlying risk in the business, so I'm not going to borrow very much money. Tata Motors is a cyclical company. In fact, of all 5 of my companies, Disney probably has the most predictable cash flows because it's in the entertainment business across multiple components of the business, in broadcasting, in movies, and theme parks. So from that perspective, I would expect again Disney to borrow more than the other company. Already you can see on the first 3 issues, you already see that Disney is going to be the company that you'd expect to borrow the most money. Then you get to agency costs. So here's why I want you to think like a banker who's lending money to these companies. And I want you to think about which of these companies you'd be most concerned about your money being misused and you not being able to catch it. You lend to Vale, you see the mines, right? For better or worse, they're physically there. You lend to Disney on a theme park, you feel pretty good. There's a physical infrastructure. But you lend to Baidu, it's a technology company. I don't even know what their assets are. You might have no way of monitoring them. From an agency cost perspective, Baidu probably has the highest agency cost, and companies with physical assets have the lowest. And finally, on future flexibility. This is a function of how uncertain or certain you feel about your future investing needs. If you're in a business where things are settled in, you feel pretty comfortable about these are the investments I expect to make over the next 10 years, and you're not going to deviate from that. And from that perspective, I would expect, again, Baidu to value flexibility the most because they don't know what's coming down the pike. The technology could change. A search engine could become the most, it could be a great search engine today, but not be used 5 years from now. So from the cost perspective, it looks to me like Baidu will borrow the least. And if you look across the companies, without looking at the numbers, I would expect Disney to have the highest debt ratio and Baidu to have the lowest debt ratio. You're saying this is all very subjective. I agree. And from this perspective, that's what you're getting is a subjective judgment. We will build on that today to make it more objective. But this to me is the starting point for analyzing debt, is to take your company, the company that you're supposed to be working on, that company, right? And take it through the same perspective. Nothing I did was rocket science. Look at the tax rate, look at the need for discipline, look at the... So by now you already should have the numbers coming in on your company that you should be able to make this trade-off. And at least on a very subjective level, tell me whether your company is the kind of company you'd expect to borrow a lot of money. Company with stable earnings, lots of physical assets, fairly good idea what's coming in the future, as opposed to a company that shouldn't be borrowing very much. So now, I'm going to take that trade-off. And yeah, go ahead, question.
My question is about the rating of these companies. So how do you relate that? So these companies have a certain rating?
Given the debt. Everything is conditional, right? Your rating is a function of your debt, right? What does it measure? Which component of the trade-off are you measuring when you look at ratings? Is it tax benefits? No, ratings agency. Is it added discipline? No. It becomes a measure of expected bankruptcy costs. So basically, if you borrow money and your rating drops dramatically, that's a function of expected bankruptcy costs going up. So ratings measure bankruptcy costs. They don't cause bankruptcy costs. So if you're in the kind of business where I worry a lot about uncertainty and you go out and borrow money, your rating is going to drop a lot more than if you're a company with stable earnings going out and borrowing the same amount. So you have ratings. So for each of these, there is something, some proxy you can use to capture that risk. With tax benefits, it's the tax rate. With added discipline, it's how much of the stock is held by the managers. With bankruptcy costs, it might be the rating or an interest coverage ratio if you don't have the rating. With agency costs, it might just be what percentage of your assets are physical and what percentage are intangible. So when you compare across your 6 companies or 5 companies in your group, those are some of the things you're going to focus on to make that judgment. So here's what I'm going to do. I'm going to put you in a Twilight Zone episode. You might already be there and I'm joining you there. It's one of my favorite shows of all time. So here's how the episode opens. You're in a world with no taxes. I'm kind of liking this world already. It's close to April 15th. I put in a world with no taxes. In this world, managers do exactly what they're supposed to do. In other words, they take good projects, they reject bad projects, they act in the best interests of stockholders. In this world, no firm ever goes bankrupt. In this firm, nobody lies. You go to borrow money from a bank and you tell the bank you're going to take safe projects, you take safe projects. If you have risky projects, you explain it. So everybody tells the truth. And every company knows its future financing needs with certainty. Okay? You ready? We're in this universe. I'm going to go through the trade-off and you tell me what happens to each item in the trade-off. In this world, what are the tax benefits of debt? 0, no tax rate. What's the added discipline effect of debt? If managers are already doing the right thing, what the heck would you need debt for? So it's 0 and 0, so no benefits. What about expected bankruptcy costs? Nobody ever goes bankrupt. That goes to 0. Agency costs come from the fact that people lie to banks all the time. But if I'm telling the truth, agency costs go to 0. And if you know your future financing needs with certainty, then the need for flexibility also. So you have 0, 0, 0, 0, 0. So debt has no benefits. Debt has no cost. So how much should you borrow? It doesn't matter how much you borrow, right? You can borrow nothing. You can borrow 100 million. You can borrow 1 billion. You've just derived corporate finance's most famous theorem. I told you in the very first class that corporate finance as a discipline is about 60 years old. Traced back to a paper written in 1958 by Merton Miller and Franco Modigliani. This is called the Miller-Modigliani Theorem. It's the birthplace for all of corporate finance. And here's what it says. In a world with no taxes, no default risk, and no agency costs, it does not matter how much you borrow. You're saying, what does that even mean? Your value as a business will be the same whether you have 10% debt, 20% debt, or 80% debt. Your cost of capital as a company will be the same whether you have no debt or 90% debt. It'll be a flat line. One of the great tragedies of the Miller-Modigliani Theorem is there are generations of people who've gone through corporate finance classes, and you ask them what's the only thing you remember about the capital structure sessions? They'll say it's a Miller-Modigliani Theorem. How convenient. I don't remember any of it, but it doesn't matter anyway. There are people out there who hold on, lots of people out there who hold on to the Miller-Modigliani Theorem. And every time you want to talk about debt, they bring it out like garlic with a vampire. You talk debt? Miller-Modigliani, Miller-Modigliani, back off, Miller-Modigliani. Essentially stop all discussion of debt. And the arguments they use are so internally inconsistent that they should listen to themselves talk. I'll give you an example. 1986, first year that I taught here, somebody graduates from my corporate finance class. I had no idea what I was doing then. I still have no idea. He goes to work for an LBO outfit. It was actually the outfit that was involved in the Bloomingdale's LBO in 1988. Bloomingdale's was part of a company called Federated. There's a certifiable lunatic called Robert Campbell. You see, he was actually insane. But he's an insane deal maker, and bankers don't care whether you're sane or insane. You're a deal maker. They jumped on the bandwagon. They did this LBO, a leveraged acquisition of Bloomingdale's, took it private, and it blew up because there was a recession right after. So this LBO outfit he works for blows up, goes bankrupt. And he lands on his feet. He goes to work for another investment bank. 3 years later, I run into him somewhere on Wall Street. I ask him what he's been doing. He explains to me what used to work for this outfit that was involved in the Bloomingdale's deal. And I said, look, I never quite understood that deal. Why would you borrow so much money and buy a specialty department store, a high-priced department store? It sounded at the time that you were borrowing too much. And his response was, don't you remember Miller-Modigliani? They said it doesn't matter how much you borrow. And I said, I'm glad you live in a world with no taxes, no default risk, no agency costs. But remind me again what happened to the outfit you used to work for without a trace of irony. He said it went bankrupt. You know what the irony here is? You're talking about Miller-Modigliani. What's one of the central pillars of the Miller-Modigliani theorem? Nobody ever goes bankrupt. So let's be completely open and clear about this. Unless you happen to live in this Twilight Zone world, in the world that we live in, with taxes, default risk, and agency costs, it does matter how much you borrow. The Miller-Modigliani theorem is an incredibly useful theorem to get started because it brought in the trade-off. That's where the trade-off was born between tax. That's the advantage of the Miller-Modigliani theorem. And in fact, you could argue that the Miller-Modigliani theorem is what we use today to come up with the optimal mix of debt and equity. The conclusion of the theorem is in fact the least interesting part of the theorem, but that's what people hold on to. So you have leverage people doing LBOs who blow off the fact that they have a lot of debt. So Miller-Modigliani, you're not in a Miller-Modigliani world. You can't keep drawing on the conclusion of Miller-Modigliani to say it doesn't matter how much you borrow. So let's be clear. You can borrow too much as a company and put yourself at risk. You can borrow too little and hurt yourself because you're not getting the tax benefits. One of the things we're going to explore is what is that right mix. There is a point at which you should stop, and that point is going to be different for different companies. So before we embark on that process, I want to talk a little bit about what companies actually do. If you look at what companies use to raise money, the way they raise money, there seems to be a financing hierarchy. What I mean by that is if you left managers to their own devices, there are preferred ways they like to raise capital, and you move down the ranks. And there are actually surveys that go out and ask managers, if you had a choice of where you could raise money from, what would you like to do? Before I show you the list, I'm going to give you two things that managers seem to value in their decision making. The first is they value flexibility. They value being able to change their minds, to move quickly. They value being able to make decisions without somebody looking over their shoulder. And they value control. Managers value flexibility. They value control. If you think about those two big criteria and you think about how you can raise money, let me list out the different ways you can raise capital as a business. You can use retained earnings. Retained earnings is just internal equity. I think of it as internal equity because it disciplines me to remember that retained earnings is not free. Just because it's your company's earnings doesn't mean you can treat it as zero cost, because that could have been paid out to equity investors who could have reinvested back in you. So you have internal equity. So as I go down this list, think like a manager. You value flexibility, you value control. Think of where you'd like to go to raise money. So you can use internal equity. You can borrow money. You can issue new equity. You can issue preferred stock, which is like debt but without the tax benefits. You can issue convertible debt, which is debt with an equity component to it. So let's think of those five choices. You have retained earnings, you have new debt, new equity, convertible debt, preferred stock. As a manager, you value control, you value flexibility. What's the best way to raise money for you? What's the way of raising money where you don't have to answer to anybody? Retained earnings, right? Because the way it's structured right now is you don't have to justify to companies why you retain earnings. They have to justify why you should pay more in dividends. So retained earnings comes with no strings attached and complete control. So given a choice, retained earnings would be your first choice. Now comes the tricky second choice. So you got retained earnings, you used as much as you can, but you still need more money. What would you like to raise that money from? Debt, equity, convertible debt, or preferred stock? Why debt?
Because you have control.
You have control, at least in the sense of you still have to answer to the banker on making the interest payments, but as long as you make the interest payments, you don't have to go through a prospectus, you don't have to issue justification for raising financing. Straight debt or convertible debt? Keep it simple. You want to use straight debt. So second, let's see if the actual hierarchy matches up. Don't turn to the next page. That'll be cheating. Okay? So you got retained earnings, you got straight debt. What should be third on the list? Convertible debt, equity, or preferred stock? The third choice happens to be convertible debt. Why? Because you have debt and you have an equity option, but again, nobody's holding you accountable. You're just throwing this freebie into the debt. Then comes common stock, and then comes preferred stock. And if you get really desperate, you issue convertible preferred stock. This is what, and these financing hierarchy studies have been looked at across the world. Across the world, this seems to be the layers that companies use in terms of raising funding. So retained earnings, straight debt, convertible debt, common equity. And this shows up in a couple of places. One is when you look at the financing mix that companies use, and this is for US companies, I'm breaking down how much of the financing in any given year comes from internal financing. So that gray portion of the graph is what comes from retained earnings. How much comes from common and preferred stock? That's the orange portion. And the blue portions of that, you look at every single year from 1975 through 2015, what you see is the bulk of the financing for US companies comes from retained earnings. Here's another way to think about this. You know how they run, you see these tombstone ads in the Wall Street Journal where a company announces how they're going to raise capital? Here's what I want you to try next. Next time you open a tombstone ad and you see a company, you never heard of the company, but all you see in the tombstone ad is they're raising convertible preferred stock. That's all you know about the company. And I ask you to guess whether this company is in financial trouble, whether it's financially healthy. Based on what they're using, I'll argue that they're in deep, deep, deep trouble. Any company that issues convertible preferred is scraping not just the bottom of the barrel, it's going under the barrel and digging up dirt. You don't do that if you have choices. So if you don't believe me, try this out. Open up the journal, look through the journal for the tombstone ads you see every day. Just look at what companies are issuing and form judgments about the health of the company. Then go check out the company itself to see if it holds. It's amazing how well what you use to finance your business tells me a great deal about the health of your business and where you are in that hierarchy of health. So if you look at a company like Microsoft, it's been around since 1986. Huge growth company, right? If you look at where it came from to where, you know how many times it's issued shares since 1986? Not once. It has never issued another stock offering since its IPO. So once it did its IPO, it was done. Facebook has not issued new shares except for a little trick that they've played, which is when they buy companies like WhatsApp, they do a share offering. So Facebook is not as clean as Microsoft. And here's the difference. By the time Microsoft went public in '86, it was a self-sustaining company. What do you mean by that? Essentially, the big growth had already been paid for by venture capitalists. It was now a public company that could stand alone. And until the 90s, that's when companies went public, is when they felt they didn't have to go back to the equity market to stay alive. And then you got to the 1990s and the game changed. A lot of companies that would have stayed in the VC business started to go public saying, it's okay, we can raise fresh equity if we need to. But you look collectively at all companies, you'll find that new stock issues are uncommon relative to new debt issues. It's not the way companies like to raise money. Any questions? So now let's talk about the trade-off. Yeah.
What's the big issue with convertible preferred?
Okay, let's start. What's the problem with preferred stock? First, in the US, how does preferred stock work? Can anybody describe how preferred stock works? You want to try?
You get some dividend.
It's more than, it's not just some dividend. You're given a fixed dividend. You're told you're going to get $4 in dividends every year in perpetuity. That makes it like debt, right? It's like an interest payment with one bad problem. With debt, when I promise you an 8% interest rate and I make the interest payment, what do I get as a little bonus? I get the tax deduction on the interest. Preferred stock is just extremely expensive debt because I make that fixed payment and I don't get the tax deduction. So given a choice between debt and preferred, I'm going to go with debt. And the companies that go with preferred are usually companies that are losing money, that don't care about the tax benefit, or can't afford to borrow money. Adding a conversion is always an admission of desperation. Right? Basically, what are you doing? You're adding a sweetener to a security to get people to buy the bond. You would not do that unless you felt you had to do it. So when you throw the conversion option on preferred, you're already taking a pretty bad way of financing, and you're potentially making it worse.
So it's a bond that
It's a bond with equity options attached to it. And the reason you're throwing the equity it's a non-tax deductible bond with an equity option. So if I describe it that way, saying, why would I issue it? Because you're desperate. You need the money to keep going. And that's one way to think about this. The more complex your security becomes, the more you're telling me I'm desperate. The simpler your security is, the more you're telling me I can raise money. So it's in fact a very simple way of separating healthy from not so healthy companies is to look at the complexity of the security used. Yes? No, the whole security converts to equity. You can't have your cake and eat it too, right? Basically what you have is you keep it as a bond, you collect interest payments and a principal payment. You convert to equity, you get shares, and whatever you get with shares, dividends and price appreciation. So it's not that the security is a package, right? So the bond, you get coupons and a principal. With equity, you get dividends and price appreciation. So you get that choice of saying, do I want to stay a bondholder or do I want to convert and become an equity investor? Yes? Usually that's specified in the security. So if it's a convertible bond, let's say it's a 10-year convertible bond, you might be able to convert it all 10 years. Some convertible bonds, a conversion option might be live for only the first 5 years. But usually at the time the bond is issued, it will be described as part of the bond. So that conversion option goes with the bond. It's attached to the bond.
Right, but when the bondholder will decide, okay, I'll convert.
Okay, let me put the question back to you. When do you want to convert your bond into stock? What's going to drive that decision?
When I feel like converting it to the active portion will work more than the bond.
And what drives that whether it's worth more? What are you looking at to make that judgment? You're just looking at the stock price. So if you buy a convertible bond in a company when the stock price is 5 and the stock price goes to 50, you're going to convert. Why? Because you're going to get a lot more in equity value by converting and holding shares than by staying with the bond. So with a convertible bond, you're making a partial bet on the stock, and if the stock does really well, you convert and become a stockholder. So it's really driven almost entirely by what happens to the stock price. Conversely, when the convertible bond is issued when the stock price is 50 and it goes to 5, guess what happened to your conversion option? It disappeared. You basically ended up with a straight bond, which you didn't want anyway. So a lot of people who bought Twitter convertible bonds when the stock price is 50 will look at the bond and say, what the hell did I buy here? I've got a straight bond in a company that doesn't make money, that doesn't expect to make money, that might never make money. It's not the kind of company you would have gone and issued the straight bond for, but that's what happens. A lot of Tesla convertible bondholders are thinking about converting right now. Why? The price is up to $290. The convertible bonds were issued when they were at 120 or 125. So it's all driven by what happens to the stock price. Any other questions? Yes?
When we do this type of analysis for our own firm, should we compare it? Like, does it make sense for us to compare it to comparable companies in the same industry, or just
Compare it on what sense? So the question was, when you look at your company's capital structure, you look at the makeup of financing. When you say compare it, what are you comparing it for? What's your end game here? Why do you want to compare it?
I guess we can make a judgment about
It's unusual. So for instance, if you have a company in a sector where everybody issues convertible bonds and you issue convertible bonds too, it might make you feel a little better that you're in the midst of insanity, that everybody is as desperate as you are. If you're the only company in a sector where everybody else issues straight bonds and you're issuing convertible preferred, I don't even have to do much comparison to know that you're in trouble. So there is an advantage at looking at the rest of the sector, but at the same time, you've got to look at yourself and say, should I be doing what everybody else is doing? A lot of young startups, you issue convertible preferred. You know why? You're a young startup. The VC says, this or nothing, what would you take? You say, I'll take this. And it's really a reflection that you're at that moment at the bottom of the barrel, but as you move up, hopefully you can replace that convertible preferred with common stock when you go IPO or when you raise fresh venture capital. It's a nature of how companies kind of mature. So now let's talk about the right mix of debt and equity. So this judgment call we made of trading off the tax benefits and added discipline, it's a nice way to get started, but it doesn't tell you whether the right mix of debt and equity for your company is 30%, 40%, 80%, or 0%. So I want to find a way to come up with a more, I won't say precise, at least a number. So if you say, what's the right debt ratio for me? I'm not just going to say high debt ratio. I should be able to say 40 to 50%, 20 to 30%. So I'm going to go through 5 different ways of trying to come up with the right debt ratio for your company. I'm going to start off using something we've already used before to try to answer this question. Remember we talked about cost of capital so far as a hurdle rate? It is a hurdle rate, but I'm actually going to argue that I can use the cost of capital to answer a different question. What's the right mix of debt and equity for my company? So I'm going to use that. I'm going to start with that as my basic approach. Then I'm going to talk about some of the limitations of what I'm assuming in that approach, and I'm going to come up with what I call the enhanced cost of capital approach, where I bring in this indirect bankruptcy cost that you worry about as a company. Then I'm going to talk about what's called the adjusted present value approach, an approach that is practiced very sloppily in the real world. So we're going to talk about how to do it right and why people end up using the sloppy shortcut that they do. With adjusted present value, you keep the debt separate from the rest of the company. And you look at the benefits and costs of debt as an added value. Then I'm going to talk about what I think most companies do. Most companies, we ask them, how do you come up with your debt ratio? Do what Bella suggested. Look at everybody else in the sector and say, if they're not borrowing money, we're not going to borrow money. If they're borrowing 50%, we're going to borrow 50%. If everybody's borrowing, and we'll talk about what it is that draws companies to the sector average. And finally, I'm going to come back and talk about the life cycle approach, which I've kind of laid out already. You tell me where your company's in the life cycle. I'll tell you the right mix of debt and equity for your company. So let's start with the cost of capital approach and let's see how we can use it to try to answer the question, what's the right mix of debt and equity for my company? Let's very quickly review what the cost of capital is, and it should be very quick review because you just did this on the second quiz. The cost of capital is a weighted average of your cost of equity and cost of debt, weighted by the market values. So the real question that you have then is, how does this affect my value as a firm? And it turns out that the value of a business is the present value of the cash flows to the entire business. So think of the entire company as a big capital budgeting project. You discount back at the cost of capital. What you get as a present value is the value of an entire business. You're saying, why does it matter? What's the objective in corporate finance? It is to maximize your value as a business. If you take that to heart, then you want to find a cost of capital that maximizes your value. So let's assume you can keep your cash flows to the business unchanged and lower your cost of capital. Same cash flows, lower discount rate, my value goes up, right? And at the limit, if I can minimize my cost of capital, I get the lowest possible cost of capital, then I've maximized my value as a business, right? So one way of framing the right debt ratio for your company is to ask, what debt ratio will minimize my cost of capital? So rather than deal in abstractions, let's go through the mechanics of how the cost of capital will change as your debt ratio changes. One of the reasons I've approached estimating cost of equity and cost of debt the way I have is I know the section is coming, so I had to be ready for the section. So let's go back and review cost of equity. Cost of equity for a company is risk-free rate plus beta times equity risk premium, right? So let's take those 3 inputs. As my debt ratio changes, I can't change the risk-free rate. I'm not the US Treasury. I can't change the equity risk premium. That's the price of risk. But as my debt ratio changes, what happens to my beta? My levered beta is going to go up. So the way we've approached structuring the beta, you start with an unlevered beta and go to a levered beta. As my debt ratio goes up, my beta will go up. As my beta goes up, my cost of equity will go up. So let's take that as a given. As I borrow more money, my cost of equity will always go up. Always, no matter who you are. How much it'll go up will depend on what my starting point was and what my tax rate is and how much I borrow, but it'll always go up. Let's turn to the cost of debt. Cost of debt is the rate at which I can borrow money long term today. If I have a bond rating, I might be a prisoner of that rating. Right? If I'm BBB rated, that's the rate I can borrow at. But even if I don't have a bond rating, the way we estimated the cost of debt is by estimating a synthetic rating using the interest coverage ratio. But at the end of the game, we ended up with a risk-free rate plus a default spread as the cost of debt. So let's isolate that. As I go from 0% debt to 10% debt to 20% debt, as I hold all else constant, I borrow more money. What's going to happen to my default risk? It's going to go up. If you're a banker lending to me at 20% debt, you're going to see more risk in me than if I'm at 10% debt. So as my debt ratio goes up, my default spread is going to go up. The risk-free rate is not changing. My default spread is going to go up. If I can somehow estimate what that default spread will be at 20% debt, 30% debt, 40% debt, 50% debt, I should be able to give you a cost of debt at every debt ratio, and it too will also go up. So here's a puzzle. As the debt ratio goes up, your cost of equity goes up, right? As the debt ratio goes up, your cost of debt goes up. This seems like a no-brainer. If you're doing math, if both numbers go up, your cost of capital, which is a weighted average, also looks like it should go up, right? But actually, here's the mystery. As you raise the debt ratio, even though the cost of equity and the cost of debt both go up, your cost of capital, which is a weighted average, could actually go down. Why? Because here's where the cost of debt being cheaper. So what you're doing, here's the trade-off. When I borrow money, I am replacing more expensive financing equity with less expensive financing debt. But as I borrow money, I'm also increasing the risk of both. The net effect is what's going to determine whether my cost of capital goes up or down. And here's the final missing piece in the puzzle. If you think about how I'm going to come up with the default spread at every debt ratio. I have only one rating, which reflects the debt ratio today. I don't have a schedule of ratings that says this is what my rating will be. So I have to come up with ratings at every debt ratio. And here's where that synthetic ratings process is going to help me. What's the synthetic ratings process based on? What's the ratio I base it on? Interest coverage, right? Operating income divided by interest expense. As I borrow more money, what happens to my interest expenses? It'll go up. As my interest expenses go up, my interest coverage ratio is going to go down. When I go to that lookup table, guess what? As I borrow more money, my rating is going to decrease. As my rating decreases, my default spread is going to go up. Yes?
There is a range, right? There is a range.
Yeah, there's a range. So within that range, it might not. But within that range, I will leave the rating unchanged. But if you fall outside the range, so we'll talk about what having that range does to your cost of capital. It is a problem because it creates a discontinuity in your cost of debt. But it's a reality we face. There's one final loose end. I multiply the cost of debt by 1 minus the tax rate. And we do this routinely. When you multiply the cost of debt by 1 minus the tax rate, what are you assuming about interest expenses? That you can deduct them for tax. You're saying, what's the big deal? Well, let's say right now you have $100 million in interest expenses and $500 million in operating income. Then of course you're going to get the tax benefit. You multiply by 1 minus the tax rate. You tell me you're going to increase your debt tenfold. Already you can see a problem coming, right? Your interest expenses are going to go up to $1 billion. How much do you have in operating income? Only $500 million. You can't deduct more than the operating income. You start to lose tax benefits if your interest expenses start to get higher than your operating income. So I have to want to make sure as I go through this process, especially as I get to really high debt ratios, that I'm not hitting that point. And if I am, I have to adjust the tax benefit. So when you think about the cost of equity and cost of capital, step back and think about this trade-off playing out, because that's a trade-off that we're going to capture with the cost of capital. So remember again that anecdote I gave you about the cost of equity and the cost of debt. The CFO said equity is cheap because all I pay is the dividend yield. Yeah. That's not true, we said, because what am I missing when I focus just on the dividend yield? What's the other component of the cost of equity? When I issue equity, people buy the shares not just for the dividend, but because they want expected price appreciation. That's what we capture with the 9, 10, 11% cost of equity. So if you look at the cost of equity, it can't just be what you pay in dividends, it has to include price appreciation. So your cost of equity reflects that, your cost of debt reflects your default risk. I'm going to ask you a question that many of you already probably have your internship, so you've gone through the interview process. Maybe in a couple of years you can pass the pain on when you interview people. So I'm going to give you a very good question to ask somebody if you don't like them. So you got this really cocky MBA who acts like he knows everything. Here's the question to ask. Can equity ever be cheaper than debt for a company? You think it can be cheaper? Tell me what has to be true for equity to be cheaper than that.
The share price is trading at a very high level. Or is
No, if my share price is trading at a very high level, my cost of equity just went through the roof, right? Because if you buy shares at a very high level, what do you hope to get from those shares? You hope to get price appreciation. Expected price appreciation drives cost of equity. So if I have a really high stock price, it's not like my cost of equity dropped, my cost of equity just went up because the people buying my shares come in with huge expectations. You buy Tesla right now, your expected price appreciation of the stock reflects the fact that it's done really well.
If you're losing money, you're losing bad shape.
So your cost of debt is really high. But remember, the debt holder is in front of the equity investor. So you're losing money, you're in really bad shape. The guy in front of you is charging 18%. You're behind him in line. As the equity investor, wouldn't you charge more than 18%? I mean, that's the logic that's historically been given for why cost of equity has to be higher than the cost of debt. You're the last person in line.
the stockholders don't have much power over managers?
Their perceived cost, but I'm actually, but the real, allowing for the fact that cost of equity has to reflect price appreciation, not just the manager's perception. Yes? Now we're on to something. Cost of equity reflects a risk you cannot diversify away, right? Can you have a company which is very risky, but almost all of the risk in the company is firm-specific risk? It could be a young biotechnology firm, right? You have a blockbuster drug working its way through the pipeline, huge amount of risk, but it's all firm-specific risk. So when I compute the beta for the stock, I'm going to get a really small number, not because I'm doing it wrong, but because I'm capturing the portion of the risk that is market risk. Gold mining stocks, we said, could potentially have a negative beta, right? But gold mining stocks are risky. If you lend money to a biotech firm or a gold mining company, you still see a lot of default risk. Your cost of debt can then be higher than your cost of equity, and their capital structure becomes a no-brainer. How should a biotech company raise capital? All equity. How should a gold mining company raise capital? All equity. The reality is once this happens, the trade-off goes away. You don't even think about debt as an option. You just go into equity. So the answer is yes, the cost of equity can be, it's unusual, it's very uncommon, but it can happen in that special subset of cases. So when we start back on Monday, we're going to start with looking at the cost of capital as the mechanism for trade-offs. I'm going to send you a spreadsheet, but if you can enter the numbers for your, no, this is actually a bonus. If you can enter the numbers for your company, you can actually pretty much catch up on the whole project with this one spreadsheet. This is like a one-time deal. It'll be not retracted on Monday. So I'm going to send you the spreadsheet, enter your numbers, and get caught up because it's a good place to get started. Yeah. triple B rating. You can have a triple, you can be a high triple B rated company and low triple B, because markets differentiate, right? You can give a triple B rating. So what will happen in the market is within the rating, the cost of debt will actually vary depending on the higher the range and the lower.
But that's market.
It's not even market inefficiency, it's the fact that rating is very low. The market doesn't have to say. The market can say you're a very solid triple B or a weak triple B. So when you are payments, we're acting like all triple B rated companies have one default. It's an approximation. It's not the market's fault. It's our fault because it makes our life easier. And when you do the optimal debt ratio, this is going to mean that sometimes you can move from 20 to 30% debt. Stay within the same range. Have the same rating. I'll give you the same cost of debt. When in fact the cost of debt probably went down. Not by a huge amount, because you stayed within the same rating, but it went from 2.8% to 3.1%. And there are ways in which you can, if you wanted to make your cost of capital spreadsheet even more flexible, you can actually try to break your ratings down. Because after all, you can make up whatever you want. You can have triple B plus plus plus, triple B plus plus, and have finer and finer ratings. And we talk about that because it does show up potentially when you do the ultimate cost of capital that this got really affected.
So how do you come up with an optimum since it's a linear function?
You can come up with an optimum because you can still come up with a low point, right? So even though you have discontinuities, doesn't mean you cannot come with an optimum because the cost of equity is continuous. Right? Because that changes even for the smallest change in debt ratio. So as long as one part of the cost of capital equation is changing, you will come up with an optimum. The only problem is it might not be the perfect optimum because you use this range process for your debt ratio. So it might be that the optimum is 30% when in fact it's 32.1%. But the way I think about optimums is I don't think about a specific number. I think about a range anyway because there's so many numbers that can change. So when I say your optimum is 30%, I'm saying it's somewhere around 30%. It could be 28, it could be 32. I can't get more precise than that. So you can come up with an optimum from the perspective of coming up with the cost of capital that's minimized. I'm going to go with every 10% now. I'm going to go 0%, 10%. So I'm not even going to try to do the 27% optimal because that's hubris. Because let's face it, too many estimates you're feeding in. So if I say your optimal is around 30%, that's more than enough for you to make your debt decisions.
Right. Okay. Makes sense.
Okay.